Good afternoon, everyone. Welcome to today's Wednesday market review. My name is StockDarts, and we're going to do what we always do on Wednesdays. We're going to go ahead and take a look at the four major market indices. We're going to look at the S&P 500, the Nasdaq Composite, the Dow Jones, and the Russell 2000. Once we finish looking at those, we'll also take a quick look at the U.S. dollar. We'll see how it's affecting commodities like oil, gold, silver, and then we'll take a quick dive into Bitcoin and Ethereum as well, and just see how the cryptocurrency space is behaving. If anyone in here has a chart request or a chart they want me to look at, feel free to put it into the chat tab, and I'll be more than happy to take a look at it. If you like what you see here, you can always follow me on Twitter under the name StockDarts. You can find these videos at YouTube under the same name, StockDarts, or you could visit me at patreon.com/StockDarts, where I post weekly blog content, including trade ideas, watch list ideas, the repost of these Wednesday market reviews, and anything else I might think of posting during the middle of the week. Typically, if you like the way I look at charts and the way I analyze them, and you want to see more about how I trade, you can go ahead and visit me there. And I typically post at least once a week. I'll post my basic trade idea post, and it goes into detail as to how I'm going to go ahead and try to approach trading for the week. Typically, what we want to do is on Wednesdays we try to analyze what kind of market environment we're in. And once we get a good gauge of what kind of market we're in, we can go ahead and try to tailor our trading strategies to match that. That way we aren't trying to fit a round peg into a square hole, so to speak, by trying to maybe go long when a market is correcting, or try to short a market that's rallying, or trying to play momentum when the market is stagnant. You want to make sure that you're trying to match your strategies to whatever the market is doing, because in the end the market's going to dictate a lot of what most stocks do. But with that out of the way, let's go ahead and get started. First thing we're going to do is look at the S&P 500. We're going to do that through the ETF SPY. And as you can see on here, things look pretty bullish. You're going to see the theme for this week as far as the markets are concerned is a little bit of a mixed message. We're going to see the S&P 500 and the Nasdaq appear to be pretty bullish and appear to be ready to break out, but when we take a look at the Dow Jones and the Russell 2000, you'll see that those indices actually look like they're ready to kind of top out and correct. And so the big question this week is going to be which of these indices takes control of the market and tries to pull the others along with it. And like I said, we're starting with the S&P 500, and as you can see through the ETF SPY, we're looking pretty good, right? We're still in the middle of a long-term rally. Or intermediate term rally and long-term rally both. As you can see, we've had a very nice channel that started developing way back in November of last year, and here we are all the way in August, and we are still inside of that channel. This has been a very steady price movement. Interestingly enough, we've had some nice periods of consolidation, as you can see with these white rectangles, showing that despite the fact that we were rallying pretty steadily, there were moments of consolidation and chances for the market to kind of take a pause and take a breather and let new buyers come in as older buyers cashed out. And so despite the fact that we have been in a very steady channel, we actually have had a market that's been able to have overbought and oversold conditions kind of alleviated by the fact that we've had these periods of consolidation that have stretched across the boundaries of the channel. And so despite the fact that you see this long-term channel, it doesn't necessarily mean it needs to end right now, because we've had pretty good periods of sideways action to let new buyers step in. As you can see, we even had a small one very recently in the month of July, as we consolidated a little bit and had a couple of shakeouts to get rid of some of the weaker hands and let new buyers step in at what they consider to be value. And so where we are now, as I zoom in, is we have just broken past the most recent consolidation range, and as you can see, we are poised for a breakout, but at the same time kind of struggling. And so this is one of the reasons why we're seeing mixed messages across the board, is that the leaders have not fully broken out. You're going to look at the S&P 500, and then when we look at the Nasdaq, you'll see that we've broken out to new highs, and we are still using the previous highs as a floor, right? So nothing technically has been done wrong here. We're just trying to build up momentum to break out, but we haven't had the explosion that we needed to break out. Now, we've gone through a couple of pretty important weeks of earnings, with most of the FANGs, well, all of the FANG stocks already reporting, and a good majority of the bigger names that are followed reporting over the last week and a half, almost 2 weeks now. And so it looks like we've got a lot of the catalysts for movement out of the way. We had a Fed statement last week as well, and that didn't really move the needle too much. And so the market is just trading off of technicals and trading off of whatever sentiment is already in place with nothing new to kind of move the needle. And because of that, we haven't had enough positive expectations to be able to push to new highs. And so we are kind of in a holding pattern here where we either break out and extend this rally even further, or we stall out at this level and come back and have to retest some lower support levels. With the strength of this rally and the fact that it has not really breached the channel that I outlined a minute ago, or the 50-day moving average for the most part, we can expect that if we do get a pullback, that that's going to be the first area of support and likely going to hold the support unless we start to finally see some erosion in the S&P 500 and a break of this channel. Now, if we do break this channel, that's still not the end of the world. When we move to the NASDAQ, you'll see that their channel was broken quite a while ago, and it still has been able to establish a pretty good upwards trajectory and a decent trend going upwards, despite the fact that it didn't have one single continuous channel. So it's not the end of the world if the S&P 500, for whatever reason, breaks below the 20, breaks below this channel, and maybe even below the 50-day moving average. However, in the short term, that will mean that we need to spend more time consolidating and trying to figure out where we want to go next. If we do break out, which is still a pretty good possibility, then we're kind of going up into unexplored territory, right? We're still at all-time highs, or right below all-time highs, and so there really isn't any supply overhead waiting for us, or any traders that are underwater, or anything of that nature. It's really just a matter of what traders are going to consider overpriced, or any sort of theoretical resistance from traders that use measured moves or stuff of that nature, or maybe as we get to the top of this channel. And so there really isn't too much resistance, so to speak, as other than the level we're dealing with right now, which is about 441, which is maybe a point or two above where we are now. So looking at the key levels, what can we expect, and where can we look to buy dips, or where can we look to get actionable trading opportunities, right? So the first actionable opportunity would be on a breakout, and that would be, as I just mentioned, the 441 level. If we can break through this, preferably with good volume, then I think that means the market is ready to rally, and we should be able to take long plays with momentum plays, so breakouts and continuation plays. If we fail at this level and we pull back, we're right at the 20-day moving average, so it's a pretty good bet that we fail and lose the 20-day and come down and test this channel, and more likely than not dip a little bit below that and test the 50-day moving average. That's going to be the key test as far as short-term price action is concerned. So far, the 50-day has held for 6-7 months now, right? We only had 2 candles really that kind of breached it, and even then it was really just a one-day move where we shook out a lot of traders, and then we had a really strong hammer way back in March. And since then, the 50-day has been tested a few times. As you can see, since this channel started, we've tested the 50-day moving average 1, 2, 3, 4, 5, if you want to call this 2, 6. So either 6 or 7, depending on how you want to gauge or how you want to define this as either 1 or 2 tests. And each time it's held, and the likelihood is that it will continue to hold until it finally breaks. Now, you might tell yourself, well, it's probably due to break, but you might have told yourself that the last time and the time before that and the time before that. So what you want to do with a market that's this strong is it needs to be proven wrong before you go ahead and try to change or define it as a different type of environment. And so as long as it continues to behave this way, we have to go under the assumption that it's going to find support at the 50-day or at the bottom of this channel. And the longer this strings along sideways, the more likely that we do get a breakout as it starts to get wedged between this 441 level and this rising support that's coming up to meet the price. Now, does this mean you want to enter a trade early, or you want to immediately buy as soon as you see a red candle come down to the 50-day moving average? No. You still want to see proof. You still want to see the green candle that follows. You want to see, even if you have to dive down into a 15 or 30-minute chart to try to get a better clue as to what the price action is, you want to see some kind of reversal pattern. You want to see some kind of proof that buyers have stepped right back in. Same thing with the breakout. You don't want to just say, well, chances are good that we're going to break out here, so I just want to buy today. Because it could be that we need to chop around for 4, 5, 6 more days before we get to a spot where the market's ready to break out. Or it could be that we need to shake out traders to the downside. Typically, the traders that try to get in early are the ones that get shaken out before you get the breakout. You can see this is actually exactly what happened the last time we moved up, which is right here in the middle of June, where we had a nice broad range to consolidate in. We started to hint at breaking out, and then we had this shakeout move, and then was eventually met with strong buying that made the new rally that we are kind of currently in the middle of. As you can see, we've kind of extended all the way from the 410 area all the way up to the 440s. And so if you buy early, you have to understand there's a good chance you're the one that gets stuck in this sort of a mess. And then that's where you get into trouble, right? Because you stop out, and then the market rallies without you. And then, as it seems to always happen, if you hold on and say, well, I know what's going to happen is it's going to rally as soon as I sell, you hold on, and that's the one time that the market starts to correct even further and punish you. And that's the way the market works. It punishes a lot of traders because there are a lot of people that are having the same thoughts as you when you're looking at a chart. And so you want to make sure that you remain disciplined and you wait for the right price action to tell you what the next move is going to be, right? And so the best we could do is postulate theories, and there are two basic theories that can occur, obviously during any week, which is we either go up or go down. But in this case, we either break 441 or we need to come down and test the 50. Now, if we actually break below the 50, let's say that this is the end of this channel, we have a very strong price point right below that at about 423. I don't expect this to be broken on its first test. When you consider the amount of time that we spent from April to the middle of June and even all the way up almost into July, trading in this range between about 400 and about 420, it's a good chance that if we come back and retest it, we did test it once real quick on this pullback, but this next retest is probably going to be one that's going to be met with buying support as well. So even if this channel breaks and it looks like, well, the rally's dead, that's not necessarily the case, and the one thing that might be the real case is that we need more time to trade sideways, and this is likely going to be a good spot for the floor of that sideways action, at least in the beginning. So if you're looking to buy dips, then you want to be looking at the 50-day moving average, or you want to be looking more closely at this 422 area. And besides that, like I said, the other key is to look for a breakout to the upside. So those are the key levels. If I had to bet, I'd say there's more chances that we try to break out in the next couple of days. I think the S&P 500 and the NASDAQ are the leading indices right now, and they're the ones that are trying to pull the other two with them. Whether we fully break out or not is up for debate. That's the same exact analysis we had last week, where I expected us to push to new highs, and we did. But as you can see, the manner with which we've pushed to new highs has been a little muted, and we haven't had a very strong move past that. And so the longer this takes, the more likely it is that maybe we do pull back. But for now, I'm still thinking that there's more chance we break out than we do pull back. And if we do pull back, I think it's probably going to be a shallow pullback, at least initially. Now, if we look at the NASDAQ, we're going to see basically the same pattern. Slightly different, of course, but in the short term, we've got the same thing. We've broken out to new highs. The test of previous highs is not quite as clean because we didn't really have that much of a time spent trading in that range, right? In reality, I would actually say that this is more of a, we'll change this to solid lines to give a better picture of what's going on here. I'd say what we have here is basically a bull flag. And again, this is a bullish continuation pattern. This typically resolves in the same direction as the previous trend, which would mean that we likely are setting up for a breakout. And like I said, if you're looking at the S&P 500 and the NASDAQ, we have pretty bullish charts. And this is, for the most part, a textbook bullish chart. We've got a breakout to new highs, we've got a little bit of a shakeout, we get a consolidation range on slightly less volume, and then typically this resolves with a breakout, and you want to see the volume kind of at least tick back up above average as that happens. But to kind of backtrack a little, you can see the NASDAQ, that channel that started in November, it broke pretty early. And this looked like it could have been a major turning point in the market, but in reality it was just a market that, it was just an index that needed to take a little bit of a break. and reestablish where buyers would want to find support. And of course, this was part of a larger pattern of rotation away from tech stocks that did well throughout 2020 towards recovery stocks that were doing better in 2021. And what we're seeing now is a rotation back into tech. And I think that this is going to continue as we begin to see more and more negative news come out again about a lot more infections coming back into the population. As you know, I live in Florida, and Florida has started to set records again as people continue to get sick, even if they have the vaccine. And I think as we see more and more of that kind of negative news, these tech names, these stay-at-home names, they're going to start doing better again, and they're going to start recovering a lot of the areas that they lost as we kind of took a break and started looking forward to recovery. And now that the recovery is not necessarily in danger, but we're seeing hints of people having to maybe start to work from home again or spend more time kind of quarantined or in masks, we might see some of these tech names start to reestablish a breakout. And that if that's the case, we could see the NASDAQ break out, and it would still not necessarily mean that the Dow and IWM break out with it, which is the pattern that we are seeing clearly, which I'll point out as we get to those two as well. And so that is another issue that we're seeing here, and why we're going to see a little bit of a disconnect between the NASDAQ and the S&P 500 versus what we're seeing on the Dow and IWM is because, well, we're starting to see rotation back into these stay-at-home names, which tend to reside in the NASDAQ and are a lot of components in the S&P 500. And so these are the kinds of things that we try to analyze on these Wednesday streams, because it helps us figure out where we want to look for trades. And like I said, I think with what the patterns that we're seeing right now, I think it's good for us to maybe want to stick to tech names and keep an eye out on the recovery of a lot of these names that started to struggle as that rotation came into play between the stay-at-home names and the recovery names. All right, so let's analyze the NASDAQ in a little bit more detail and see exactly what's going on here as far as what levels we can look at and rely on. All right, so first up, obviously, is resistance. We're going to zoom in a little bit to take a look at it. You can see we've got a major level here at 368 that we're struggling with. Support, we're at a key support, which is, of course, the bottom of this bull flag, which is also the 20-day moving average, which has supported price as we started to break out. Now, I do want to point out, this is something we pointed out last week, and even the week before that, that the moving averages are starting to align or have already aligned in a formation that usually indicates that there's a strong trend coming. And what I mean by that is, obviously, the moving averages are lagging indicators, and they tell you what the price action has been doing. And it's a good idea, not necessarily to use them as trading signals, but to give you a better idea of what exactly the environment is. And when the moving averages are sideways, and they're just kind of crisscrossing together like spaghetti, that usually is indicative of a market that's trading sideways, obviously. But when you see them start to curl up, and you see the 20 start to expand, and you see the distance between the 20 and the 50 really start to change, that is usually a good sign that a trend is starting to emerge and is likely to kind of continue. And that is exactly what we've seen over the last 2 or 3 weeks. And if this can continue, then we should expect a breakout here, and we would expect the 20-day to kind of curl right back up and the 50 to keep swooping up above it. And of course, the 200 hasn't changed because we've been in a rally for a long, long time in the long-term view. So, like I said, we've got short-term resistance right where we are. We've got short-term support pretty close to where we are. The next level of support, when you have a stock or a trend or an equity that's moving in this sort of manner, is actually the moving average, right? So in this case, it's actually going to coincide with the last pullback we had, right back down to about 352, 351, and that's exactly where the 50-day moving average is going to come up to meet price. So if we do fall out of this bull flag, we should come up and test the 50, and I would expect that to be a test that's met with buyers, and I would expect that to be a good buying opportunity, at the very least, for a bounce to make its way back up into this to the 20-day moving average, and maybe even up to the previous highs. So that would be the first level of support. Now, just like the S&P 500, if we lose the 50-day, we've got a much stronger level of support that we could focus on right here around 342, which is the ceiling of that range of consolidation that we spent a lot of April, May, and June in. And much like the S&P 500, I would expect that to be a level that would be met with pretty good buying on the first and maybe even second test of it. So that would be a key level. If you're looking to buy the dip, if you are very hesitant to buy where the market is right now and you think that it's overpriced, and you want to be patient and wait, well, there's nothing wrong against that or with that. And what you want to do then is you want to see what happens as we meet with the 50, and then more importantly, what happens if we lose the 50. We come to here. You don't panic. You just wait for a good buying opportunity, and you wait for the right patterns and the right chart patterns and consolidation ranges to give you an idea of where to go ahead and buy. All right, so that's the NASDAQ. Like I said, basically three key levels. One is right where we are. The next is the 50-day, and the last is going to be right around 342. We look at the Dow Jones, and we're going to see a contrast to that. In this case, yes, technically, we're still doing the same thing. We're hovering just above or just below highs. The difference being, we haven't actually left that range of consolidation that we spent all of April, May, and June in. As you can see, July has basically bled into that, and this channel has not really changed. Now, we are at a very, very critical point here on the Dow, depending on how you draw that trend line that I just extended a bit. But if you take a look at what's happened here, the Dow Jones has also been in a channel since back in November. Now, it has had a little bit of, there are definitely some asterisks we could put on this, right? Because it did threaten to break down a couple times, and then it actually broke above the channel and kind of resided above it for a while, right? So this channel isn't quite as clean or as intact as maybe what we're seeing in the S&P 500, but the general trend has stayed the same, right? And if you look at if you just ignore the bottom of that channel and you look at the 50-day moving average, you can see that again, we tested the 50-day, broke below it, tested the 50-day real quick, tested the 50-day and actually held well below it for a while, and then tested it again and had a 2-day change. So we've had quite a few tests of the 50-day moving average, and for the most part with the Dow, it actually has threatened and has actually broken down for brief periods of time through that, and it's coming right back. And as the moving averages curl up together, you can see that the moving averages on the Dow, they're not quite in the same place as what we saw with the NASDAQ. We have them starting to flatten out. We have them starting to cross, and if they're going to continue this pattern, more likely than not, what's going to happen is we're going to pull back and break back through, and then the 20-day is going to cross through the 50. So give me a second. Sorry, my dog is really wants to play right now. All right, so as I said, the moving averages in this case are not giving us the same picture as what we're seeing on the NASDAQ and the S&P 500. Now, it could be that we break out and the 20-day starts to curl back up, and in that case, then the moving averages start to align more closely with what we're seeing on the NASDAQ. But for that to happen, we're going to need the price action to reestablish the price above 351 and actually break out of this range that it really hasn't been able to break out of. Now, as I mentioned before, we're seeing a pretty interesting pattern here again of capital rotation away from industrial names and names that are going to benefit from recovery and back into stay-at-home names. And if that's the case, it could be that we see the Dow falter here and start to lose this channel and start to trade sideways, just as the NASDAQ and the S&P 500 start to sort of slowly climb back upwards. And if that's the case, again, I think it's more indicative of a market that is still sort of neutral, and there will just be certain areas that go up and certain areas that go down. And if that's the case, then we just have to make sure we're picking the right stocks or the right areas to look at stocks. I think the clear levels here, the Dow Jones, the levels are very clear and easy to identify. Obviously, resistance is this green line, and this is going to be the turning point that we need to see broken. Either it breaks above this, or very clearly it's going to break below this ascending trend line and its moving averages, in which case we can expect to move probably all the way back down to the 336 to 340 area. And at that point, we would expect buyers to step in, but a lot would depend on exactly what the news stream is telling us with regards to COVID and whether recovery names are looking for a bounce or not. Um, so for the moment, I'm not interested in trading the Dow components. There's not that many of them. And I would rather trade tech names until I see the Dow actually break out of this range and start to make its way up and possibly follow the Nasdaq and the S&P 500 with it. And I think that's going to be the key. If SPY and the Qs actually break out, does the Dow follow? And if not, then I think, again, that's going to tell us something about the market. Now, if those two break out and the Dow breaks down, that doesn't mean that I would not trust the S&P 500 NASDAQ moves. Like I said, it could be indicative of just a big rotation in where stocks are going. If all three break out together, I think that's a good sign overall for the markets. And I think that would mean a much stronger rally than what we'd get if the Dow doesn't participate. And then the last index is, of course, the small caps. And they actually are by far the weakest looking chart. And again, you can see if you just look at the moving averages, don't even pay attention to anything else, it's pretty indicative of a neutral environment and an equity that's just chopping back and forth. So what do we expect here, and what can we gauge out of this? Like I said, I think that this tells us that money is rotating out of small caps, right? Tech, energy, biotechs. Some biotechs have actually done well because of the response to COVID. But generally speaking, a lot of smaller cap names, they're more volatile, and traders right now don't trust them. And I think a lot of the reason they don't trust these small caps is not necessarily because of the risk associated with a smaller cap or more volatile asset, as much as the risk associated with an equity that is correlated with the recovery process and with people going back to work and traveling. And that's not what we're seeing right now, as we're starting to see a kind of an increase in people getting infected again. Can this change? Yes, it could change very quickly. Will it change? Probably not, at least not in the near term. This looks like we want to head back down and test the 200-day, not like we necessarily want to come out and test the new highs. And so, like I said, this is where we start to see a very big disconnect in the market. When we were looking at the other three indices, especially the first two, we had a picture of a market that's ready to break out. But as we move forward towards these other, the Dow Jones, and now especially with IWM, we've reached a spot where we are looking at a market that maybe doesn't look like it wants to break out. In fact, looks like it needs to consolidate a little bit further. Now, you'll notice again, we also had a channel that lasted for a little bit of while, and then that broke, and it turned into a very broad sideways range. It could be that the small caps are following the footsteps of what the Nasdaq did, and they just haven't been able to break out through that, and they're kind of in the middle of this stage right here. Calm down. And if that's the case, then it could be that we get the momentum necessary to break through that. But we don't have to guess, right? Because we have exactly what we need to see here. If it breaks, it needs to get back above the 20-day moving average in the 50 before we even have to think about it going back to test the top of its range. So in the short term, that's the levels we need to watch, is how it goes ahead and navigates through these moving averages. And as you can see, the 200-day is going to be a moving average of consequence as well in the near future, and one that we have to see how IWM goes ahead and navigates around or behaves with. And so, totally different picture here. I would say definitely stay away from small cap names right now until we see a better picture or see something change, at least as far as the small caps that are behaving like this. Like I said, there are some small caps, particularly the ones that I've seen are the ones related to COVID, such as, vaccine names or mask companies. Those have done well, of course, but you're looking at other names, energy names perhaps, they're not doing as well, and if they're doing this sort of a pattern, you probably just want to stay away. You probably want to look at other stocks that are giving you better patterns and better chances of a move upwards, because if you turn on the news and it says, oh yeah, the S&P 500 near all-time highs, and you're assuming that everything's okay and it's going to be easy to trade, and that's not necessarily the case. We have a market that is a little bit more difficult to trade than you would think when you consider the fact that we've been in an upward trend since November, because not every equity is behaving in the same manner as what the overall market indices are doing. So you have to make sure that you are picking out the right strength and avoiding the weakness. All right, so that's the four major market indices. Those of you that are in here, if you have questions regarding anything I just said, feel free to type it in, and I'll be more than happy to elaborate. Let's go ahead and take a look at the U.S. dollar. We'll see that U.S. dollar, again, a lot like the markets, has been kind of confused as to what it wants to do next. You can see that we had a nice breakout from a pretty steady range as the U.S. dollar tried to establish a firm bottom. But we've lost a little bit of ground, and we're right back into that range, this big yellow rectangle. If we look at the euro-US dollar, which is going to be an inverse of what we just looked at, and I'm going to zoom out a little bit. You can see what the US dollar, now again, in this case, up is good for the euro, down is good for the US dollar. And so you can see the US dollar has put pressure on the euro, and then most recently the euro did get a nice little bounce, and it came up, but it failed right at an important level of resistance that we've been watching. And it's kind of coming right back down, which means the US dollar is starting to gain a little bit of strength. We're not getting a clear picture yet as to what the US dollar wants to do next. It's really just chopping back and forth. I think that is part of, not necessarily what we're seeing with the markets, but I think what we're seeing is all equities at the moment are not sure what they want to do next. And I think that's reflected in the US dollar as well. If we look at the US dollar versus the yen, we're going to see, again, the US dollar lose a little bit of ground over the last week or so. The overall picture, I think, is still okay. And I think it's starting to set up, matter of fact, with today's candle, it looks like maybe it's ready for that. Starting to set up for a bounce. And then finally we have the US versus the Canadian. And it had a very nice rally. For those that follow here, I know not too many people trade Forex, but I had mentioned this as a very good long opportunity a few weeks ago. And that turned out to be quite the case, as we had a very strong move going all the way from the low 120s up to about 128. It has since pulled back, and we can start to see a little bit of a bounce. Now, this is going to be correlated with what what we're seeing on crude oil, and the fact that crude oil is starting to drop again probably means that the U.S. Canadian is going to kind of move up again. Ray, I'm not sure if you're in here, but if you are, I hope you got out of this trade and you're not still in it, because if you are, it looks like we're headed right back down to 66. And there's a decent chance that as it comes back and tests that level, that we even head a little bit below that. Oil has, if we think about the thesis that I was postulating a little bit earlier with the markets, and how it looks like we're rotating back into stay-at-home names and away from recovery. If that is indeed the case, and that pattern plays out longer, then that means that the anticipation for energy demand is going to be less, which means that oil prices will probably go down, as we expect people to stay at home more and drive less or not travel, which means less airplanes flying, which means less gas or whatever. And if that's the case, then oil probably fails at 66 and heads back down and starts testing towards the 60s. Now, getting a little ahead of myself, or ahead of the chart, obviously 66 is a strong level of support, at least in the short term, and there's a good chance that oil stabilizes there. But what I'm seeing here, again, if you just focus in, this is why sometimes it's good also to just kind of gauge what the candles are doing. If you look at the overall size of the candles, they're starting to get more volatile, showing the volatility is coming in, and even more importantly, most of that volatility is in the down candles. Yes, we had this big green candle on this rebound day at 66, and maybe this candle here, but for the most part, the majority of the volatility is taking place on down days, as we sell off pretty sharply, particularly these last 3 days. And so it's looking to me like we are starting to see a lot more selling pressure coming into the crude market, and it would be interesting to see if buyers come in and defend this area again, or if they kind of capitulate and we end up dropping below the 60s. And so at the moment, I am not looking at 66 as a buying opportunity on oil. Now, that could change. We could get another hammer candle, maybe another another couple strings of hammer candles, at which point it looks like buyers stepped in, and then we could go ahead and look at buying. But at the moment, this looks like it wants to head down and really test this level and see if it holds. So this again, I think, is just another one of the signs telling us that maybe this recovery trade is starting to slow down, and that we need to look at stay-at-home trades again. And again, stay-at-home, by what I mean by that is Amazon, Netflix, some of these smaller companies like Zoom or DocuSign, which benefit from us working or just kind of staying at home and having to do not only work from home, but even our consumption. So stuff like Netflix as well, Peloton, that sort of thing. All right, so that's oil. Now, if we look at gold and silver, interestingly enough, with well, not interesting. I mean, it's pretty standard behavior. But with the U.S. dollar dropping in the last few days, you can see gold picking up some momentum, and probably going to be the same case in silver in a second. Now, I mentioned last week that this is probably an okay trading idea, although it's not one that I was interested in trading because I don't see enough of a return in gold and silver right now compared to what I can get out of Bitcoin assets or crypto assets. However, for those that are into gold and silver, this looked like an okay opportunity to go ahead and try to play a long play. You can see we drew exactly what we wanted to see. We got that breakout, and it came up, tested the 200-day, and we're right back to that level. Now, this looks like, again, we've got a gap fill here, and that gap fill ended up coming, we ended up getting a drop off of it, but we've come right back to it. We're breaking above the 200 and the 50. Gold could continue to rally here. I think a lot of it is going to depend on what happens with the U.S. dollar, of course, as always. But this is actually a decently bullish pattern. Is it a pattern that I'm interested in? Still, probably not personally. But I would not necessarily criticize someone who's watching this and who's long, particularly if they got long at this breakout. But even here, the risk reward's not good for an entry here. But this looks like it maybe wants to continue to try to make its way back upwards. Actually, well, did that just flip to green? From green to red? Oh. You know what? For some reason that candle was green before. The red candle's not a good candle. Because that means the price action is down here at 169. Maybe I'm crazy. I thought I saw that candle as green. Here's SLV doing the same thing. So, yeah, I would say at this point we want to wait because that's a big drop. So at this point, yeah, maybe you want to stay away from these and wait for a different pattern. Now, again, like I said, with gold, the key level right now is going to be what happens at this gap fill. And if it can get back above the 200 and the 50-day. SLV is kind of stuck in neutral. And as you can see, didn't quite have the same bullish pattern that GLD had. And again, this was a very difficult move, which is something that I explained in detail last Wednesday. I'm not going to go into too much detail, but these 24-hour markets that are traded with equities that only trade during normal trading hours are very difficult sometimes to trade because there's a lot of gaps up and down. That's one of the things that I really like about the next sort of equity we're looking at, which is Bitcoin, is that I can go ahead and enter it. It's a 24-hour market cycle, but I could enter it at any time of the day I want, not necessarily during trading hours. Now, as we can see with Bitcoin, very strong move. It was able to get above a very key level, which is the 40,000 level. It did falter and come back below that, and that's not necessarily a positive sign, but I would say it is decisively away from the bottom here and from the threat of a further breakdown, and has at the very least graduated back to neutral. I think for anyone that's into cryptocurrencies, this is kind of like a small green flag saying that you could go ahead and start trading other equities as well, some of the smaller crypto assets. Now, ideally, we want Bitcoin to resume its climb here and get back above 40. It doesn't necessarily need to get back to its 200-day or up into the 50s or 60s, but it should hopefully get back and stay above 40 and kind of start to leave this big consolidation range behind and start to look forward towards these other areas I just mentioned, like the 200-day and maybe even the 50,000 range. If you look at Ethereum, Ethereum has actually done the same sort of thing. It's actually had a very strong move. And now it's coming up into resistance around 28.75. And if you were long Ethereum, I would say that we are getting close to what is probably a good opportunity to take some profits. Um, this is looking pretty bullish. We have a pretty big news event coming in the next couple of days. Um, and that could lead to either a further move. A lot of people are anticipating a move back into the 4,000s. However, I look at the fact that this might be a sell the news event as we've rallied into it. And so if you're a crypto trader and you bought this bounce and you're not holding this long term, I think we're getting pretty close to a spot where you want to take some profits as we approach this 28.75 range and see what happens there. However, like I said, the one good thing is I think that gives us a green light to look at other smaller altcoins that have also started to perform better. You can see a big sea of green here as a lot of these smaller coins are finally starting to pick up some momentum and start to really pick up steam and go ahead and follow through and follow what Bitcoin and Ethereum are doing. All right, so that covers what I wanted to look at today. I am still pretty focused on cryptocurrencies. I know that's not something that people tune in to watch here, but I do want to point out that that's opportunities that are being missed if you are a trader and you don't have exposure to that. Now, as far as the stock market is concerned, I am still focused on more, at this point, on tech names. And I'm looking at tech names, particularly tech names that already had their earnings and maybe pulled back to support and are starting to pick up some momentum off of that support level. If anyone in here has any questions or something they want me to look at, feel free to type it. If not, we can wrap it up. I think from here to next week, like I said, we're looking at a market that might want to inch up a bit, but the key is going to be how we go ahead and break through those highs, and if we don't, how we do when we come back and test probably the 50-day moving average for the most part across the board. All right, well, it looks like that's it for today. Like I said, anyone that's watching this as a recording, or even those here that maybe don't have a question to ask now, you can always follow me on Twitter at StockDarts, and I'll be more than happy to answer any questions you have on there throughout the week. Just go ahead and shoot me a message, and whatever time of day it is if I see it, I'll go ahead and respond and give you my take on whatever chart you're looking at or whatever question you may have. Hope you guys have a good rest of this week, and we'll meet again next Wednesday.